This is the Haulin Assets podcast, where we show you how to start and run your own trucking company. Ever wanted to go out on your own? Follow Chris as he goes through the highs and lows of running on his own authority. Welcome to the Haulin Assets podcast, a motorcarrierhq.com production. I am Craig, your host, and over there he is Chris. Hello, Chris.
Hey, how's it going?
It's, not bad for me. Not
Good.
bad. How are you
I'm
this
doing
week?
well.
All right. And who's sitting next to you?
I brought a friend.
And who's your friend?
This is Nate.
Hello, Nate. How are you?
Good. How's it going?
Good. It's good to have you here.
Thank you.
So Nate actually is a friend and a business partner.
Whoa.
Yeah.
Hang on.
Okay.
You have friends?
Well, not many.
Oh, okay.
Well, I claim him as a friend. He may not claim me.
Depends on the day.
Yeah, there's a lot of people I claim as friends that probably don't claim me.
That's right. That sounds like my junior high anthem. Okay, well, we're going to learn more about Nate in just a moment. Before we do, though, Chris, I just want to remind everybody to go to HaulinAssetsLLC.com, where they can check out full show notes. They can get documentation from this and other episodes, especially our financials episodes, which this is not one of. Today, we're going to be talking about how to manage your cash flow. Okay, so all the notes that we're going to be providing, they're going to be there at HaulinAssetsLLC.com. You can also find us on Facebook. Leave a note in either place. You can also leave a note on iTunes or whatever it's called now, Apple Podcasts, wherever you listen to your podcast. Please leave
us notes everywhere.
Yeah, leave us a 5-star glowing review. It would be much appreciated. And once you've gone and left your review, of course, come back and listen to this episode all about cash flow. Chris, before we get to the actual topic at hand, of course, I got to ask you, what's new with you this week? How are things been going?
Things have been going well, and as we were kind of getting ready for this podcast, as you know, and as hopefully most of our audience knows, we've got a business partner in Haulin Assets. We brought Nate on in January of this year to kind of help
run
operations, and really, he's the one that does a good chunk of the workload with Haulin Assets these days. And so we were talking about, this podcast. We decided we were going to do one together, bring Nate on, and we were talking about, well, what should we do as our intro? And we started talking about what's kind of been going on crazy in the last little while. And it really boils down to, we've had a lot, especially this last month, more so than normal. We've had TONUs. Do you know what that is?
I haven't the foggiest notion.
Well, it's
as far as I'm concerned, it's gas, Chris. So you're going to have to let me in on the secret.
So it's an acronym. It stands for Truck Ordered Not Used.
Truck Ordered.
This is one of the most frustrating things that happens in the trucking industry is when you sign a rate confirmation, you have this contract essentially to go haul this load, and you show up at the shipper, and then the shipper says, we don't need you for one reason or another.
And they just cancel. And okay, so let me ask you this. Before you go any further with the story, is there any contractual thing you can do about this? You can say, no, you hired us, you're using us, or you're paying us one way or the other.
They'll usually pay you a consolation prize, I guess you could say.
Okay. Yeah.
It's usually not much, a couple $100, but a lot of times you've deadheaded, a decent distance.
Mm-hmm.
You've spent time, you've spent money getting to where you're going, and that consolation prize, that couple $100 or whatever it is that they throw your way, never compensates for what just happened.
This is essentially Han Solo flipping the change to the bartender saying, sorry about the mess.
Yeah, exactly.
Okay, all right. Okay, now you're speaking my language. I feel like I understand where we are. Okay, so you have a TONU, if you will.
So imagine being a driver and you deadhead 150 miles to a location.
Okay.
You sit there and wait, and then you don't even get your load. Essentially, they tell you to go away. It's just like the most demoralizing thing in the industry. And so the driver's ticked off. We as the company, the owners and the carrier, it's frustrating for us financially as well. And then at the end of it all, what's next? So the other day we had, a couple weeks ago, we had 3 in August, which is increased. Usually there's like one a month. But as we've got more trucks, more loads, statistically it's just going to go up, unfortunately. Right. So we have 3 in August. And one of them, for example, happens on a Friday at noon. And a lot of shippers and receivers aren't open or as available on Saturday and Sunday. So we get this at noon, the driver had just deadheaded 150 miles and gets word, hey, this load doesn't exist anymore.
Oh, man. Yeah, that's got to be frustrating.
Just like, oh, and by the way, it's Greg, our new driver. So we're like, so I'm like, oh my gosh. I'm talking to Greg. I'm like, this happens. He's got 20 years plus of experience. He's like, I know it, but you still feel bad. So anyways, so I hop on the phone with Jake. Jake makes, like, not joking, probably 15 to 20 calls for probably an hour and a half trying to get him a load out.
Jake being the dispatcher. Yep. Okay.
For the weekend, so that Greg has something to do. Essentially the broker says, there's nothing we can do till Monday.
Right.
Okay, we're not going to sit for like 2 to 3 days. So luckily, after an hour and a half, Jake gets a load. Greg's being super patient, just sitting there. Most drivers, you could totally expect them to be frustrated. And then he deadheads again, like, I don't think it was quite 150, but something close to that. Gets a load. Finally, Saturday by like 8 or 9 at night, he has a load. He now has been going all day long.
Yeah, and he's finally got the load.
The load, and then now he's underway to his destination.
Yeah.
So super frustrating. That's where that consolation prize, $150, really, like,
it's almost salt in the wound at some point.
And sometimes they're more than that, but it's pretty meager compared to an entire day or a significant portion of the day wasted. And it's just one of those, no one in the industry likes it, and you never know if you're hearing what you're hearing is truthful, or like everyone always wonders is who's screwing me, who's doing this.
So let me ask you a question from Greg's perspective then. Okay, this is Craig putting himself in Greg's shoes. I promise this is not the first time I get Gregged all the time, and I'm sure he gets Craiged all the time. Okay, so from his perspective, he gets paid by the mile. Does that count the deadhead miles that he drove, or is he out as an employee? Is he out that nearly 300 miles deadhead before he ever even gets on his way with a load?
So we pay deadhead. It's not everyone's business model to pay deadhead, but we do. And then when it's a really bad circumstance like that, completely out of a driver's control, we usually also compensate them a reasonable amount. So he maybe got 300 miles for that day, where he should have got 600 or 700 based on the hours he worked.
Right.
So then we'll kick in a few extra $100. But luckily from our perspective, we also probably got that to some degree from the truck order not used paying out.
Okay.
So that's usually how it works. But other companies have different ways. There's a lot of different pay methods.
Yeah.
Just to like put it into perspective or wrap a little bow around it, you think about it. In this situation, you've deadheaded 150 miles on Friday. You get there at noon. You should be loaded with a load and on your way by 2 or 3 o'clock in the afternoon, and then drive another 300 or 400 miles. Well, in this situation, you essentially more than 24 hours later, with very few miles driven, you're nowhere where you should be. So the truck's not making money, the driver's not making money. It's a bad situation. So that's where we try to compensate the driver as much as we can from that truck not used fee that we collect from the shipper. But it's still, I mean, you've gone from what should have been, $1,000+ in revenue over that 24-hour period to almost nothing.
Yeah, that's got to be super frustrating. I mean, it's frustrating to me just listening to it, honestly. I don't even have to handle these things. But, I really just wanted to make sure I thanked both of you for starting the podcast off on such a positive note, helping me learn about truck order not used. See how I get the lingo, Chris?
Yeah, you're down. You got it down.
But so is there anything else to that, or should we move on to our main topic?
We were talking a little bit about how it seems like maybe that's increased a little bit, and I was thinking, it's probably one of those side effects of a really good rate market, because carriers are doing really well, getting really good rates right now, and so brokers are trying to do every little thing to kind of swing the pendulum a little bit more in their favor. And so it's probably because they can find a cheaper truck sometimes, and they're just going to drop it on you and place it with a less expensive truck, somebody who's willing to haul the load a little bit for a little bit less money.
Boy, that seems like a place that's ripe for a little bit of industry reform.
It's a shady business practice, but there are brokers that do that.
Yeah. Okay. All right. Well, shady business practices aside, maybe we should talk about cash flow, Chris.
That's what we're here for, right?
Okay. All right. So the title of the episode is Managing Your Cash Flow, or How to Manage Your Cash Flow. But I think the best place to start, especially for an idiot like me, is, hey, Chris, what's cash flow? Can you tell me what cash flow is?
Well, before we even get into cash flow, let's talk a little bit. Let's bring the elephant out in the room and talk about why we're even talking about this subject.
Oh, okay.
It's kind of an embarrassing story.
Something brought this up.
Why don't you tell it since it's embarrassing?
Oh, yes.
I knew he'd put this one on my shoulders. So legitimately, like, we bounced a check.
Well, okay. So Haulin Assets bounced a check.
Yes.
All right. Well, luckily, it wasn't addressed to me. But okay.
It's been a long time since I've bounced a check. It was kind of embarrassing.
So a little background is our bank account would fluctuate 10 to 20, 30,000 at times pretty quickly. Within a week or 10 days, it would go fluctuate like that. And we both watch it quite a bit. But we had a bill come in for something like $4,000, and we didn't have enough to cover it for a day or two period. And that's what kind of brought this up. I approached Chris the other day. I was like, hey, this would be a good subject, because we have struggled with this as we've gone from 1 to 2 to 3 to 4 trucks over the last 6 to 8 months. This has been a real struggle for us, which has actually been a bit shocking. I would have thought that we're both very conservative. We really don't take much out. And I thought we would have been totally fine, but it hasn't been. And there's a few reasons why.
Yeah. So what brought all this on? I mean, Chris, you're the evangelist here for savings. You are the Dave Ramsey of this podcast.
Yeah. Well,
so what gives?
We're going to talk a little bit about, so maybe let's take our step back now to like what you were saying. Let's talk about what is cash flow. And then we're going to get into, kind of what caused our situation and some other situations that you need to look out for when cash flow can be an issue.
Okay. All right. Go for it. So what is cash flow, Chris?
So cash flow is, it's really simply put, is the amount of money coming in versus the amount of money going out of the company. And a lot of people will think of cash flow and essentially net income or profit as the same thing. And they're not really. They're different, because there are some things that can increase your cash flow that don't have an effect on your profit and loss or your net income, and vice versa. There's things that can decrease your cash flow, again, that won't have an impact on your profit and loss. So they're two completely different things.
Okay. So if you don't mind, I'll take a stab at it. It sounds like a loan, for instance, is a little bit tricky, because that's not your money. I mean, you're going to have to pay it back, but it is money coming into the business, right? So that's not net income, but it's still cash coming in. And then on the flip side, paying back that loan, it's an obligation you already had, but it's not. Gosh, I don't know quite if I'm explaining this right. You're not losing money. You're just paying it back.
You're right. You're right there with it. So let's use an example. So if you've got a 50,000, say you have a line of credit, and you tap into that line of credit, you bring $50,000 into the business. So that's a positive cash flow of $50,000. So you could have had a month like we did last month where we lost $4,000, but essentially your bank account goes up and you've got more cash in. And so, if you were looking and using your bank account as your measuring stick, as your gauge, you'd be like, oh, everything's good, even though we're losing money. And if you do that again and again and again, even though at one point you had a lot of money coming in, positive cash flow from the bank loan, reality, your company is not necessarily healthy.
Right. I'm actually being reminded, if anybody else is familiar with the entertainment industry, Netflix, they have a lot of money coming in, but they borrow like crazy to make billions of dollars annually worth of content. This is what I'm thinking of, is where they'll spend $19 billion on content in 2021 or whatever, but they'll maybe bring in $10 billion or $15 billion in revenue. And some of us are left scratching our heads. How can a business survive? But they're, at least in the short term, they're looking at cash flow versus just their net income to see what the health is. And
that's very common early on in a company's life cycle, to have that kind of thing happen, where you're funding your operations through loans or through other means. And so that kind of keeps you cash flow positive, even though you're losing money. And so you just have to really be able to understand and distinguish the difference between the two, and realize there's a difference between cash flow and net income, and they don't necessarily work in tandem. You can have a positive cash flow and a negative net income. That's not sustainable forever, obviously. And then vice versa, you can have a positive income and a negative cash flow. And so the point is that you've got to be cognizant of that cash flow and how much money you've got, how much cash you've got coming in versus how much cash you've got going out, and not just your profit and loss.
Right. And I mean, like you said earlier, it's tempting to look at your bank account and say, hey, I put 50 grand in the bank this month, but in reality, you lost 4 grand, but you got a loan or, tapped into a line of credit or whatever. So it's that bottom line can be deceiving when you're looking at these two concepts, right?
It's a tricky concept, cash flow, and you've got to be careful of it. And because, it can get you into trouble, and you should never, ever, ever use your bank account as kind of your gauge with how well your business is doing because of that cash flow issue. It's cash flow is not net income.
Right. Okay. So what else do we need to know? Is there any other setup with the concept of cash flow, or can we start getting into what your situation was and what caused all this?
Yeah. Let's get into the different situations, or kind of the business life cycle. And we'll kind of do this in order for the most part of a business life cycle of when you really need to kind of be conscious that cash flow oftentimes becomes an issue.
Yeah. Okay. So where do we start? Yeah, I guess we start with when you started the business.
Yeah, when the business starts. I mean, we were talking about that with the Netflix thing. I mean, a lot of the big companies, big startups, especially tech startups, Netflix, Tesla had this same thing. They'll go years, and sometimes like Tesla went almost a decade negative income, and they weren't making money for like 10 years. And Netflix, I can't remember how long it was, but the same thing. There's a lot of companies that go a really long time without making a profit because they know that they're eventually going to be able to turn a profit and make all that money back, but they have to manage their cash flow to compensate for the money that they're losing. Mm-hmm. And that's whether that's getting loans or getting equity investors or any number of things, but you've got to be careful. So that startup phase is the first time when you really have to be careful that cash flow can often be negative, and you got to be careful of that.
So how does this relate to a trucking company then? Because obviously we always got to bring it back to that when, whether it's you starting Haulin Assets or somebody else thinking about going out on their own, starting their own company, what do we need to know about this concept in a trucking company when you're first starting out?
So Nate, you remember, I mean, we've talked a little bit about this, what our net income, or not net income, but our net expense per truck, what the total expense per truck is?
I think we're hovering. I think the safe side say 20 grand, but really it's probably more like 18 if nothing goes wrong, no large expenses.
So from the history of Haulin Assets, it's been anywhere between about 15 and 20 grand a month is what our actual operating expense for a truck. So that's the fuel,
per month,
the driver,
per truck.
per month per truck.
Okay.
And so if you think about it, when you and also you've heard of these terms, Craig, right? Net 30. Have you ever heard of the payment terms, net 30?
If I've heard of it, I've forgotten it. Chris, did I ever tell you the one class I ever failed in college? Accounting. All right,
that's not a good class to fail, Craig.
Go on, Chris.
All right, so payment terms net 30 is pretty typical in not just trucking, but in a lot of industries. And what that means is that you complete the job for me today. You submitted an invoice requesting payment today. I'm not going to pay you for 30 days. That's kind of normal operating procedure for most businesses.
Right.
And so if you think about it, if you start your trucking company today and you go haul your first load, you get it all delivered, and you're going to bill $2,000. You bill that to the shipper or the broker, whoever you're hauling the load for. Well, they're not going to pay you for 30 days. So you essentially have to pay the driver pay, the fuel expense, the insurance, everything that goes with operating a truck. You have to pay that for a whole month before you start seeing actual income hitting your bank account, that positive cash flow coming in. And so that's one of the big reasons in that startup phase for a trucking company why cash flow becomes so tight.
So, yeah, I mean, and you've talked about that before, where when you're first starting out, it's not necessarily hey, I have enough money to go buy a truck and get it registered, that doesn't mean you have enough money to start your business, right?
Yeah.
Am I remembering right? So
Yeah.
you need a little extra padding to make it through that first 30 days at least,
Yeah,
right?
so
Maybe the first 60 days.
There's a couple ways that companies how you can kind of mitigate that cash flow shortage. One of the biggest is factoring. That's why a lot of trucking companies, when they first start out, use factoring, because with factoring you can complete the load today. You can essentially sell the invoice to the factoring company, and they'll pay you the vast majority of that amount owed the same day or the next day.
Right, and just take a little cut, and then
they take a little cut. They
later.
collect. They do all the collections, the billing, all that, and it makes it so the trucking company has to worry less about the paperwork, the collection side. It kind of helps mitigate the risks that they're hauling for brokers and shippers that are actually going to pay their bills, and then they get their cash right away, and then they can use that cash to help fund the operating expense kind of going forward.
Right. Yeah, I can imagine that would help quite a lot. And so, Chris, you're pretty familiar with factoring, right? You've mentioned that you have a factoring company, and so you're helping guys do this all the time.
Yeah. So I Thrive Funding, the factoring company that I'm an owner in. Yeah, that's what we do all day long.
Okay. All right. So, is there anything else we need to know about that startup phase or factoring or anything else before we move on to the next phase?
So the next thing you can do if you've got enough money, if you've just got an extra really $20,000 to $30,000 laying around to fund that first 30 to 45 days of operating expense, then you can do it without factoring. But most people, like you mentioned, by the time they've paid their truck down payment, they've paid for the registration, they've paid for insurance down payment, all those things that happen with the startup, most people are pretty much out of cash at that point.
Right.
And so factoring makes a lot of sense.
Okay. And so then once you're established, you've got your cash flow going, right? So we're past the first 30, 45 days. And I mean, people who have listened to the show for a long time will recognize the phase that you were in, Chris, for a while, where it's like, hey, I'm hitting the road, I'm making money, I'm spending money, I'm building the business, and that goes for a while. And for somebody who is just on, they're on track to be a single truck owner operator for a long time, they can kind of just sit in that phase for a long time, I would imagine. But if somebody wanted to grow the business, as you've done, hire drivers, purchase trucks, whatever, then we move on to a different phase of building a business, right? The growth phase. You're not the startup phase, but the growth phase, right?
And that's really where we got ourselves into trouble, is in that growth phase. And that's why we ended up running into where we ended up running into issues. It's kind of interesting, over the last week or so, Nate and I have been doing what, in the medical industry, you'd call a postpartum, or in the military world, you call your after action review. What happened? Why did this? How did we get to this point?
Debrief, Chris. Let's go with debrief.
Yeah, there you go. There's lots of different things you can.
Normal people use that.
Well,
look at me, Mom. I'm normal.
Anybody who has listened to this podcast knows that I'm not normal. All right, so basically, I mean, we had the one truck for a good solid year and a half, almost 2 years, maybe not quite 2 years. And then when did we bring the second truck on?
So
when did Vinny start?
The second truck
driving?
ran in like February to March for 6 weeks.
Of 2021?
Yeah, 2021.
Okay.
And then we ran into a little crunch in May, middle of May. We hired 2 drivers all at once. So we went from 1 to 3. I mean, that's probably been our most extreme, where the second truck had sat for a little while. We had got truck number 3. It had not ran yet. So all of a sudden that was probably our first real crunch, when we went from essentially 1 truck's bills or invoices funding 3 trucks. So that was our first time. And then this last time where we got a little bounce that check, we went from 3 to 4. And so we had 4 trucks of expenses.
And you think about
this
it.
sounds so much like you guys are talking about babies. The way that people are like, yeah, 3 was a lot, but then somebody gave me that 4th one and I just started drowning. Right?
They are our trucks are kind of like little babies. Yeah.
Okay, sorry, Chris. What were you going to say?
So the thing is like during this whole time too, to compound the problem, like we're having to put down payments on trucks. We're putting out all the startup costs with the new trucks, and then all of a sudden you're adding all these operating expenses for a truck, and we quickly go from 1 to 4 trucks essentially over about a 4 or 5 month period, right? And it just created a cash flow issue because we never really got a chance to kind of breathe. So we one truck, you have the second one, you let it run for it's got to run for essentially 30 days before you start seeing that extra money from that second truck come in. And we really, because driver number 2, Vinny, quit right at the same time that we were adding the third truck on, and those trucks, that truck it sat for a month and a half by the time we got two drivers hired and that second and third truck really running. So it was almost like we had to start all over again, right? Because now we've kind of run that cash out, and you add that second and third truck, and it compounded the problem, and we didn't really get much of a breather between the time that we added the third and the fourth truck, and we were just cash crunch, watching the checking account every day to try to prevent from a check getting bounced, and we weren't even able to prevent that from happening, and it just.
So it was something where you saw it coming and couldn't stop it.
Yeah, basically.
Okay. So is there any way to stop it for somebody who sees it coming? Is there anything you can do about it?
Yeah, be smarter than we were. Yeah, that's probably the biggest thing.
Done.
Yeah.
All right.
It's probably that you see this happen out of the trucking industry too. This isn't exclusive to trucking, but when you try to grow too fast, it's really easy to have this kind of thing happen. And we, in reality, we didn't intend to grow too fast. We should have had that second truck going in December. I mean, we had the truck physically, and if Vinny wouldn't have quit and moved on, it probably wouldn't have been quite as bad of a problem. But the moral of the story is it's probably better to spread those trucks out a little bit more than we did. And part of the problem is the fact that we're also adding one truck when we only have one truck. So you're essentially doubling your fleet, going from 1 to 2. And so that's a big impact. It
Right.
makes it harder. If you've got 20 trucks and you're adding one more truck to it,
That's a 5% growth.
it's 5% growth. It's not a big deal. But when you've got one truck and you're adding a second one, that's a pretty big impact. You don't really have a deep set of trucks making money to kind of help bootstrap
Right.
that truck that you're adding on. And same thing, even for the first 5, I would say, maybe once you've got 5 running strong, you can probably add a truck without too much of an issue. But I think with that 1 through 5 trucks, you probably need to space them out a good 2 or 3 months. What do you think, Nate?
I would say at least. You asked the question, what did we do? Luckily, neither of us are crying, shedding tears, or feeling it at home. Luckily, that we have some savings in other places that we're able to compensate for it, or factor. I mean, that's what I bet 90% of the industry does during their growth phase and startup phase. In addition to one thing that we haven't mentioned, but in addition to like these hurdles we talked about when Larry and John came on, truck 2 and 3 kind of all at once. So we went from 1 to 3 almost overnight, and then 3 to 4 when Greg came on. In addition to that, all the payments don't get paid on the 30th. I mean, there is a reasonable percentage that carries over to 40, 45 days. And if it was a guaranteed payment on the 30th, net 30, that'd be one thing. But you have to account for late payments. They're going to happen. We constantly always have probably 3 to 5 payments that are late. And that's something to account for, because if you don't account for it, it's going to be reality. So you might as well plan on it.
Yeah. In the factoring world, we call this average days to pay. And you think about it. I mean, my factoring company, this is what we do all day long. We're really, really good at it. And our average days to pay usually averages around 35 days. Most trucking companies, us included, that's not our focus day in and day out. And so most trucking companies, the average days to pay are probably more like 35 to 40.
Right. Okay. So if I understand the situation, and I'm trying to put myself in the owner operator's shoes, what you're saying is it's pretty tough to get those payments in a timely manner, and a factoring company exists to do that. That is the purpose, is to gather these payments, to get the invoices paid, right? So an owner-operator, the benefit of factoring is not only the cash flow, so you get that money quickly, a high percentage of what you were going to get anyway. You get it quickly, so you have positive cash flow. And in addition to that, you aren't spending a bunch of time hounding the invoicees trying to get that money. So it's freeing up some of your time in exchange for a small portion of that invoice. And getting your cash flow going sooner rather than later. Am I on the right track here?
And you are, and that's exactly one of the benefits of factoring. And in reality, a factoring company, a trucking company that's using factoring is not going to have the same cash crunch issues typically that when you're growing that a company that's not factoring would. Because if you think about it, you add truck one today, it completes its first load in 3 days. You submit that invoice to the factoring company, they buy it right then, and you've got your money within 3 or 4 days of that truck hitting the road. And so you don't typically have those same kind of issues. Now, I'm obviously kind of biased because I own a factoring company. I see the benefits to it, but I also want to be completely transparent here that factoring has its place in the industry, and there's times that it's beneficial for a company, but there's also times when you may find that it's not the right thing for your company to do. And so that's a decision for every company to decide on their own. Just kind of keep in mind what the pros and cons of factoring are, and when it's good to use it and when maybe you don't need it, and do what's best for your company.
So I know this isn't a factoring episode per se, but because we're on the subject, I'm curious, what are some of the cons of factoring, and when and why would a company either not do it at all or stop doing it after they've started?
Well, the biggest reason, it's like any other service that's provided in anything else that you do. There's a cost for that service. And so there's a cost for somebody else doing your billing and your invoicing and your collecting and all those kind of things. And then there's a cost for fronting that money, that loan piece of it. So the biggest con of factoring is just that it costs money. And you decide, well, at some point you may grow to a point where you're at a steady trajectory. You're not really growing anymore. You don't need that help with growth. And you may decide, hey, you know what, the cost isn't worth it for me anymore. I'm going to just manage my own billing, collecting, invoicing, and I'm going to wait the 30 to 45 days that it typically takes to get paid.
Right. Okay. All right. So, by the way, Nate, anything to add to that? Pros and cons of factoring?
I was going to say one other pro to factoring is usually they have a tolerance for different brokerages. So they'll help keep the ones that they don't think they can collect on for whatever reason. They'll help keep them out of the mix. And if you're trying to do it all on your own, it would be a lot easier for one of those to slip through, and maybe one would default on you, wouldn't get a payment at all. Where factoring companies, they're large, they do it all day, every day. They're going to be better at it, and they're going to say, hey, that doesn't meet our parameters. That broker, let's go with this other load, even though it's a slightly lower paying load or whatever it may be. So they're going to help damage control there somewhat.
Okay.
It's one of those ounce of prevention's worth a pound of cure. Factoring companies have credit mechanisms or credit tools that they can go back and look at that broker and say, okay, hey, this broker typically pays in time. They've got good financials. The likelihood of them paying the invoice, whether it's 30 or 40 days down the road, is high. Whereas they can also say, hey, this is a new broker. They have no payment history. We have no idea if they're going to pay the load. They could be fraudulent. The factoring companies just have some mechanisms to just protect you as the carrier and themselves as the factoring company from taking a load from a bad broker.
Yeah. Okay. So if I'm utilizing factoring, I want to get away from it for some reason. Want to save the money, like you said, Chris. I don't want to have this extra expense anymore. How do you do that? Because now we're talking about cash flow being the money that you're bringing into the business, making sure that it's the lifeblood thing. The money must flow. It's like spice in Dune, right? The spice must flow. What's the best way to go about weaning yourself off that? Should you go cold turkey? Is there a way to not go cold turkey?
Well, to go cold turkey, you have to have a good chunk of savings. You essentially have to have that $15,000 to $20,000 per truck in savings to be able to go cold turkey.
Right.
And so most people, that's just not going to be realistic. So you can wean yourself off over time. And this is another one of those areas where people tend to get into trouble cash flow wise, is when they stop factoring. So that's just one of those things you kind of have to take into account. If you decide that, it's time to not factor, then, you've got to have some money set aside. You wean yourself off slowly. There's a couple things like that you can do to make it so that it's not too as painful as it could be. Because if you just try to go cold turkey and you don't have any savings, you're gonna ruin your company.
Okay. All right. Well, good. What else, Chris, do we need to know on this subject? Is there anything else that we want to talk about as far as cash flow, whether it's factoring or any other topic that you wanted to get into with this one today?
Well, there's two more things that I want to talk about, two more situations in kind of the ongoing operations of a mature company where they can get into cash flow problems as far as trucking goes. One of them is when the economy takes a dump and rates go down.
Okay, so that's
and that one kind of is self-explanatory, right?
Sure.
You may have been getting $2,000 for a load that you haul all the time, and now you're only getting paid $1,500 for it. That's going to create a cash flow issue, and so that's where it's important to have a good amount of savings at all times to kind of help you through those times. And then also, that's one of the things that I see people not do is when a situation like that happens, they don't start cutting their costs soon enough. At that point, when you see this coming, and as soon as it starts coming, it's time to take the pencil out and really be, okay, look at all your costs and what can I do to save in these. Like, this would be the time that you need to go from the NFL Ultimate cable package to probably just the basics, right?
The basic.
Yeah.
No, this it's actually calling to mind some of our very early episodes, Chris, when you talked about food on the road.
Yeah.
You were
peanut butter and jelly time.
Exactly.
Baby.
Yeah. You never did this, but you're talking about guys who would go out and they'd eat out every day. Twice a day they'd be eating at fast food or whatever restaurants. And
I did do that for a week, remember?
Oh, that's right. And you felt awful, right?
And I felt awful because my wallet was a lot lighter.
Anyway, so I mean, okay, food is, depending on who's driving, it may or may not be a small thing, but I'm sure there are things in everybody's routine where you can, take that blue pencil to it and find something else, right?
Yeah.
So, what else? You said there are a few things
that's
that might happen.
One. Another one is when fuel prices go way up and freight rates don't change. Right now, over the last 6 months, we've seen fuel prices kind of skyrocket.
Yeah, I'll say.
But rates have also gone way up. And
Right.
So they've outpaced the increase in the fuel. And so it's not causing major cash crunches for most trucking companies. But there have been times when fuel prices go way up and freight rates stay the same or even go down a little bit, and that can create a big problem because now you're spending more money on fuel and not bringing in as much.
Right. If you were paying $4 a gallon 2 years ago, you'd have been in a lot of trouble.
Yeah.
Right. Okay. All right. Well, very good. So, Chris, any final thoughts? Any last things we need to know about?
Have we missed anything, Nate? I can only think of one more thing is, something that you can do if you run into a cash crunch. What else have we done?
You just got to have a reserve to have a reserve, really. I mean, there's going to be that day every single time. If you're going to be in the industry, any industry, you're going to have highs and lows. And if you don't have that reserve, I mean, Chris harps on it all the time on this podcast, but if you don't have that, it will catch you sooner or later. You'll have a breakdown. You'll have a downturn in the economy. One of those situations we just talked about, fuel. It will happen. If you're not prepared, it's going to be real stressful.
So the last thing this is like the hit the emergency button,
break glass in case of emergency.
Exactly.
Okay.
Yeah. Broken arrow in the military, like
right.
has hit the fan. One thing you can do is turn that net 30 payment terms around. And if you have an account at like a dealership for parts, stretch that payment out a little bit, maybe make it a little bit late. Be careful on what payments you make late or later, but that can kind of help you get through one of these cash crunches.
Right.
Yeah.
And this is a good subject to where we should bring up the idea of goodwill and being a good business partner to whoever you're working with, whether it's a factoring company or the garage that you go to or what have you, where if you've built up a lot of goodwill with the people you do business with, then when these things happen, when the shit hits the fan, as Chris likes to say, when these things happen, you can go to them and possibly say, hey, look, here's our situation. Can we extend 15 days? And if you've built a good relationship, it's very possible somebody would say, hey, I get it. Been there. Yeah, I'll help you out.
Yep.
I mean, it's no guarantee, but it's possible.
No, you're way more likely to get a sympathetic ear if you've been on time. And if you're not like trying to hide it from them, you're being upfront and say, hey, I know I'd normally pay this at 30, but can you give me 45?
This isn't politics, Chris. We're open, honest, and transparent.
Absolutely. Yep.
All right, very good. So final thoughts from you or Nate on Cashflow. Anything else we need to know before we cut and run for today?
I don't have any.
I think that's it.
All right.
Covered a lot.
That we did cover a lot. And frankly, this is a topic that I know people are going to have a lot of questions about. And so, as I said earlier in the episode, I'm very serious when I say go to Facebook, go to HaulinAssetsLLC.com, go to the show notes. On those pages or on Facebook, you can, or on YouTube. Hey, we're on YouTube. Like and subscribe, everybody. Hey. You can go and submit questions, comments, and we can address those. Whether we reply to the comment or we save it, put it in our back pocket, and use it during one of these episodes. If you have any questions on this episode or others, please let us know. We would love to hear them. So, gentlemen, shall we cut and run for the day?
Till next time.
Nate, it was lovely to have you.
Thanks for having me.
Great. I was joking with Chris earlier. We need to get a little sex appeal on this podcast, so we brought Nate in. Even just for those listening, I'm sure it was a pleasure to hear a better voice than ours, Chris.
Yeah, absolutely. We'll have to do it again. I'm sure this won't be the last time we have. We bring a little bit of sex appeal to the podcast.
Hopefully, it's not over a bounce check next time.
There you go. That's right.
Under better circumstances.
Next disaster, Nate is coming back. All right. Thanks everybody for listening. Don't forget to leave those reviews, and we will see you next time.